Welcome to Lesson 3. I'm going to let you in on a dirty little secret in the financial world that nobody likes to admit or talk about: asset allocation. That's the process of choosing which asset classes and the amount you invest in. It's actually for losers. Yep, you heard me right. Asset allocation is for losers, flunkies, duds, failures, morons. Blasphemy! I know. Asset allocation is sacred to investors and financial folks. How dare I discredit, desecrate, and defile this investment commandment? What could possess me to do this? Well, the truth. Forget about investing for a second. Imagine you and your friends just arrive in Vegas. You have $500 to gamble for the weekend. You sit down at a roulette wheel. Wait, do you sit at a roulette wheel? I don't know. I guess you can tell how much I gamble. Anyway, you put a little money on red, a little on number 6, 18, 24, and 36. The ball spins, lands, and stops. You win or you lose. Whatever. That's not really the point. You spread your money around the table. Well, why? Well, it would be pretty crazy for you to put all of your money on, say, number 22. Chances are, and for you statisticians out there, it would be 1 in a 38 chance that the ball would land on 22. If it landed on any other number, any of the other 37 numbers, you'd lose it all. You'd be done for the weekend. So of course, you don't do that. You spread your chips around the table so you don't lose it all at once. But what if I was with you at this roulette wheel and I had a secret formula that could predict with 100% accuracy what number the ball was going to land on every single time? Well, would that change everything? Of course it would. Would you put your money on 6, 18, 24, and 36? Would you spread your chips around the table? Well, no way. You'd put all your chips on the number I told you would win. Yes, every single last chip that you had, you'd put on just one number because you knew it would win. If I told you 13 was going to win, would you put some on 13, but also some on 18, 27, and 31? Of course not. You'd put it all on 13. Okay, so now back to investing. Why do we split our money into different asset classes? It's because we can't predict the future. We don't know which asset class is going to win or do the best. We don't know if next year US large cap stocks will produce the best return, or if maybe emerging market bonds will do better. So what do? We put some here and some over there and even more over there. But what if we could predict with 100% certainty what asset class would do the best? Our asset allocation would look not like this, but instead it would look like this. So even though asset allocation is for losers, meaning some of what we invest in will not be the best performing asset class, it still is one of the most important things you can do as an investor to protect and build your wealth. In fact, research by Brinson, Hood, and Biebauer in 1991 confirms this. They found that asset allocation alone determines 91.5% of the variability of your returns. So your asset allocation is very important. But let me share with you a story about a client who was not very happy with what I told her. A prospect called us and confessed she had $1.4 million invested with another advisor, but wasn't sure what she was invested in or if it was appropriate. She said she had worked with this other advisor for several years, but she was still in the dark regarding her money and how much she could spend. The challenge was to dissect her asset allocation, investments, fees she paid, and to help her figure out how much she had and what she could do and afford in retirement. So the first step was to get a copy of her latest investment statement. We then plugged in her holdings into a sophisticated software program that analyzes the allocation, investment fees, concentration overlap, as well as risk. We also scoured the statement for fees the other advisor was charging. Our immediate analysis shocked both us and the prospect. Her entire retirement portfolio was 98.6% invested in stocks. And to make matters worse, it was heavily invested in volatile technology companies, many small and many in China. The prospect showed us communications from the advisor that the portfolio was well diversified and appropriate based on your age and risk tolerance. Of course, that wasn't the case. Additionally, we found that the other advisor was charging 2% per year for his services. Lastly, the portfolio had almost all short-term gains, which are taxed as ordinary income. So the woman was furious. She had no idea that her asset allocation was so out of whack and risky. We recommended a more prudently allocated portfolio for her situation and a low risk tolerance, and cut her fees by over half. We shifted the investments with high turnover that produce short-term gains and high income into her retirement accounts. Since these accounts are tax deferred, she doesn't pay any income tax each year. We then weighted her taxable accounts with more long-term growth-oriented investments, since these are taxed more favorably. So, how is your portfolio allocated? Will you find any surprises? Up next, who wants to be a millionaire? In the next video, you'll learn the proven method to become a millionaire by investing. And it's not what you think.